We use it every single day, right? But how often do we really stop and think about what money actually is, or how credit, that little promise of a future payment, really truly shapes our world? Well, today we're going to break it all down, taking a journey from ancient trade all the way to modern banking. Okay, so let's start with a thought experiment. Imagine a world with no money, not a single coin or bill. You're a fantastic shoemaker, and you've got plenty of shoes to sell. But right now you're hungry, and what you really need is wheat to make some bread. So, how do you trade your shoes for wheat? It sounds simple, but this exact puzzle was a huge roadblock for economies for centuries. And the solution? It changed everything.
That little puzzle gets right to the heart of the problem with a system of direct trade, bartering. And if you can understand this problem, you're on your way to understanding what money is all about.
Okay, so the big problem with barter has this kind of fancy name, the double coincidence of wants. It's a mouthful, I know, but the idea is actually super simple. For a trade to work, it's not enough for you to find someone who has what you want. They also have to want what you have. So as a shoemaker, you have to track down a wheat farmer who just so happens to need a new pair of shoes right at this very moment. I mean, what if the farmer needs clothes? Or what if the farmer who wants your shoes doesn't have any extra wheat? The entire system just stops.
And this is where the genius of money just walks onto the stage. It acts as this middleman, this universal translator of value. It completely breaks that chain of coincidence. Now, you can sell your shoes to anyone for money, and then you can take that money and buy wheat from anyone else. All of a sudden, trade is unlocked. It's like money becomes this language that everyone can speak.
All right, so money solved the big barter problem, but what is this stuff we call money? You might be surprised to find out the answer to that has changed a lot over the years. So let's take a look at how we went from trading cows to just tapping a card. You can see a really clear trend here, can't you? We started with things that had their own built-in value. You can eat grain, you can use a cow. Then we moved to things that were valuable just because they were rare and they lasted, like gold and silver. But the biggest, craziest leap is that last one. Today, our money is almost entirely symbolic. It's a whole system built on pure abstraction. Think about this for a second because it's kind of wild. That banknote in your wallet, it has no real value on its own. It's just a piece of paper. We call this fiat money, and its value comes from one place and one place only, a promise from the government or a central bank. We all accept it simply because we all believe that everyone else will accept it. It's a system running almost entirely on trust. So, where do banks fit in? Well, you can think of them as the heart of this whole system. It's a pretty simple cycle, really. We deposit our extra money in the bank to keep it safe. The bank holds on to a little bit of that, but then, and this is the really important part, it lends the rest of it out. That loan might help someone start a new business, or pay for college, or buy their first house. And by charging interest on those loans, banks make their profit. But they also act as this vital bridge, connecting people who have money with people who need it. And that whole act of lending, that's what we call credit. And credit is an incredibly powerful tool. It can fuel amazing growth, but it can also be seriously destructive. It is a true double-edged sword. To really get this, let's just look at two very different stories. First up, we've got Salim, a shoe manufacturer. He takes out a loan to buy materials for a big order. Everything goes well, he makes the shoes, sells them, repays the loan, and walks away with a nice profit. For him, credit was the engine for his success. But then, there's Swapna. She's a farmer who takes a loan to buy seeds and fertilizer. But pests wipe out her crops, she can't sell anything, she can't repay the loan, and suddenly that debt starts to spiral out of control. For her, the very same tool became a trap. What happened to Swapna is exactly what we call a debt trap. It's when a loan, which was supposed to be a ladder to help you climb up, turns into a cage. It kicks off this vicious cycle where any new loan you take is just to pay off the interest from the last one, and trying to escape becomes, well, almost impossible. This is the dark side of credit. So whether credit helps you out like it did for Salim, or hurts you like it did for Swapna, often comes down to one big thing. Where did you get it from? See, access to good credit is not equal at all. And that has created this massive systemic problem, the Great Credit Divide. You can basically think of credit as existing in two totally different worlds. On one side, you've got the formal sector. These are your banks and cooperatives. They're supervised, their interest rates are regulated and lower, but they almost always require collateral, some kind of asset, like a house or land, to secure the loan. Then you have the informal sector. This is your local moneylenders, traders, even employers. They are totally unsupervised. They can charge whatever crazy interest rate they want. But their big selling point? they often don't ask for collateral. This data from rural India really puts it all into perspective. Sure, banks provide more than half of all credit, but just look at that huge slice of the pie right there. Nearly a quarter of all loans are coming from informal moneylenders. That means 1 out of every 4 borrowers is probably paying incredibly high, maybe even crippling interest rates.
And when we slice this data by wealth, the divide gets even more extreme. For poor households, the informal sector is actually their main source of credit. But for rich households, it's the complete opposite. They get over 80% of their loans from those cheaper formal sources. It's this painful paradox, isn't it? The people who can least afford to pay high interest rates are the ones who are forced to pay them. So why? Why does this huge divide exist? Well, it often boils down to that one critical word, collateral. Banks need a guarantee. They need to minimize their risk. But if you don't own land or house or any other big assets, you're pretty much locked out of the formal banking system. And that forces you right into the arms of those informal lenders.
So if a lack of collateral is the big problem, then what in the world is the solution? Well, it turns out the answer might not come from the top down from some big institution. It might come from the community, from the bottom up. And that brings us to this powerfully simple and frankly brilliant idea. Let's talk about self-help groups. Here's how they work. A small group of people, usually women from the same area, they get together and they all pool their savings, little by little. From that pool, members can take out small loans at a much more reasonable rate. But here is the magic. Once the group has a proven track record of saving regularly, banks are actually willing to lend to the group as a whole, without needing collateral from each person. The group's collective trust and responsibility, that becomes the guarantee. It's amazing. And don't for a second think this is just some small-scale experiment. The Grameen Bank in Bangladesh, which pioneered this whole model, had over 9 million members by 2018. This is a proven system that has empowered millions of people by finally giving them a fair shot at affordable credit. This quote from the founder of the Grameen Bank, Professor Mohammed Yunus, just captures the whole philosophy perfectly. It's this idea that giving fair financial tools to individuals isn't just about charity. It's about laying the foundation for massive, grassroots economic growth. So we've journeyed from this ancient problem of barter to the complex credit divide we see today, and even to some amazing, innovative solutions like self-help groups. It shows just how far we've come. But it also leaves us with a really critical question for the future, doesn't it? What's the next great idea that's going to finally make our financial system fair for everyone?